Hi everyone, I'm James Hart and welcome to this Orbex Trader Education session where we're going to be talking about one of the simplest yet most effective aspects of technical analysis, and that is of course support and resistance. Now, many people simply discard support and resistance as being lines drawn on a chart at random where traders hope that price will bounce from. And while this might seem like the case on the face of it, to think of support and resistance in those terms only is to totally misunderstand what support and resistance levels are and why they are so useful. So in this session, we're going to talk through the underlying order flow dynamic that creates support and resistance, how to properly identify these levels, and the different ways you can trade these levels, including some other tools that you can use to help make your trading decisions. Now, as ever, if you have any questions during the session, please just write them in the chat function and I'll stop periodically as we go along, and also I'll leave some time at the end to answer questions. Okay, so let's jump straight in then. What are support and resistance levels? What is support and resistance? So these are simply levels that we highlight in the market that can act as turning points, and they give us some insight into the underlying order flow dynamic present in the market. So support levels tell us where there has been demand in the market and where we can anticipate that demand remains. And resistance tells us where there's been supply in the market and where we can anticipate that supply remains. Okay, so support and resistance levels simply give us a glimpse into this underlying game of supply and demand that's going on in the market, and they help us identify areas where we can look to get involved. Okay, so you can see here, this is an image of support and resistance in the market. So we've got our resistance levels highlighted here, where we have a buildup of orders to sell, which we call supply. And this is where price is expected to move lower from when tested. And then to the downside, these two lines highlight our support levels. This is where we have a buildup of orders to buy, which we call demand, where we can look for price to move higher because buyers step in. So you can see that when you start to think about support and resistance in these terms, they become a lot more than simply lines drawn on a chart at random with no meaning. They're actually giving us a glimpse into the underlying order flow that's driving the market. Okay, so this is how you should always be thinking of these terms as interchangeable terms. So resistance levels simply highlight levels where there is supply in the market, and then support levels simply highlight levels where there are demand in the market, where there is demand in the market rather. So if we look at this example then and walk through what's actually happening thinking in those terms, we can see that initially we had a lot of supply in the market. So we had a really strong sell-off here, price moving to the downside with this strong run of bearish candles. So we know there's a lot of selling pressure in the market. Then at this point here, you can see that we see a shift. So price actually reverses higher, and although we test this level several times, we're unable to break lower, and price eventually reverses and trades back up. We then trade all the way back up to this point here, where once again price reverses, and although we try to break higher, we're unable to break higher and price reverses lower to trade back down to this level. So we know two things at this point. We know that there is a lot of support in the market at this level where we have strong demand built up. So each time price has driven down to this level and tried to break lower, buyers have stepped in and driven price higher. And we also know there's a lot of supply in the market at this level here, because each time buyers have driven price up, they've been unable to break selling pressure at this level. Okay, so once we identify this dynamic starting to occur, we can go ahead and identify our resistance levels to the top side and our support levels to the downside. Okay, and then what we're seeing is simply a game, almost like a rally in a tennis match, a power struggle between buyers who are entrenched in the market at this point and sellers who are entrenched in the market at this point. So each time sellers drive price down into support, buyers step in and drive price back up. Each time buyers drive price up into resistance, sellers step in and reverse price action lower. And this is what we typically find, and this is what we call a range-bound scenario. Okay, so the conditions we're experiencing when price is behaving in this manner is simply a range-bound situation where price is reversing between support on the downside and resistance on the top side, and it's simply a power struggle between sellers who are entrenched in the market at this point and buyers who are entrenched in the market at that point. Now, one key thing to point out at this stage relates to how you actually identify support and resistance in the market. So you'll notice that my resistance levels comprise of 2 lines and my support levels comprise of 2 lines. And really, this is because support and resistance are much more sort of zones or areas in the market than they are specific price levels. And it's really important to try and understand this, because a lot of people, when drawing support and resistance, get caught up trying to be overly specific, e.g. pinning price down to a single level, whereby really the reversals rather occur in zones or areas. And so you'll find it much more useful and effective for your own trading to learn to identify support and resistance at levels instead of specific prices. And so the way I like to draw them is always, for resistance, I'll draw from the candle high of the area down to the candle close. So you can see that what actually happened here is price was driven up to this point where sellers stepped in at the top of the candle and drove price lower. And so the actual reversal that's taking place, the resistance, is actually occurring over this level here, over this zone, instead of at a specific price. So we go ahead and mark in the candle high to the candle close, and that gives us our resistance level. And then it's the same thing down here. So you can see the price trades down into this low point, and we have our candle low and then our candle close. And you can see that candle close actually lines up with these other touches at the level. So highlighting support and resistance as general areas like this, instead of picking specific prices, will be much more effective for your trading overall. Okay, so as I said, what we're actually seeing on our chart here at this stage is a classic range-bound situation. So buyers are stepping in at this point here to drive price higher. Sellers are stepping in at this point here to drive price lower. And price is simply caught up in this range-bound situation where we're not really making any directional headway. Okay, so price isn't moving up, price isn't moving lower. What you can actually see is that between this point in time and this point in time, so a period of several days, price is pretty much unchanged. So what we're really seeing is price moving lower, moving higher, but staying around this same level. So it's reverting to its mean. So we're oscillating higher and lower, but we're never really breaking out in any direction. So when we're talking about support and resistance, the first situation to consider is this basic situation where price gets caught up in a range oscillating between highs and lows, oscillating between support and resistance. However, the next stage of support and resistance trading really comes down to one of the most interesting and important aspects of support and resistance, and that is the changing nature of these levels. And again, this goes back to that underlying order flow dynamic that creates support and resistance. So previously, where we identified that orders to buy create demand, which creates support levels, and orders to sell create supply, which creates resistance, well, once these areas are broken, what we typically see is a shift in the status of that level. So once support is broken, when it's retested from the upside, when it's retested from below rather, it will typically change to resistance. And when resistance is broken, once retested from above, it will typically change to support. So if you look at this scenario here, let's think about what's happening. Price is caught up in this really clear range situation. We have buyers entrenched in the market at this level, driving price higher each time the price moves into this support. And we have sellers active in the market at this level here. So we know that we've got strong supply here, because each time price moves up to test this level, we're seeing sellers stepping back in and driving price lower. However, at this point here, you can see that we have a significant shift in the supply-demand scale, because price actually breaks out above the high of that range. And so if we think about what's happening at this point, as we talked about earlier, all that we're really seeing is a shift in the underlying order flow dynamic. So where before supply was stronger in the market than demand at that level, hence we were seeing these reactions lower, at this point here, when price has broken out above that resistance level, we know that there is more demand in the market than there is supply. So buyers are in control at this stage, and they've driven price back above these highs. So if we track forward then and see what happens, price trades up to this high point. You can see it's grinding around, moving higher. We trade all the way up to this level here, before reversing lower, and we get a really sharp sustained sell-off. You can see that we get this successive run of bearish candles, and we trade all the way back down to test that broken resistance level, and now look what happens. Okay, so previously where price had seen a lot of supply at that level and sellers were moving price lower, this time, because price is broken out above that level and there's more demand in the market at this level, when price trades back down into it, this time it acts as support. Okay, and this is the type of dynamic that I'm trying to get you to understand, is that although we can see situations like this where price is caught between support and resistance and we're simply oscillating, once these levels break, you'll very often tend to find that there is a shift in the supply-demand scale and therefore a shift in their status. So broken resistance becomes support, and broken support will very often become resistance. So we've looked now at what support and resistance levels are, and we talked in a bit more detail about the underlying order flow dynamic that create both these range-bound situations where we're seeing a power struggle between buyers and sellers, and then also we've looked at the situation where these levels change nature, whereby there's a shift in the supply-demand scale and broken resistance becomes support and vice versa. And so now it's time to think more about how we can actually trade these levels and how we can put support and resistance into practical application with our trading. So if we go back to the first example then. So what we're looking at here is that classic range-bound situation that I was talking about. So buyers are entrenched in the market at this level. Each time price tests this low point, you can see that buyers are stepping in and driving price higher. To the top side then, we've simply got the reverse situation. Each time buyers get price back up to this level, sellers are stepping in hard and driving price lower. So price is simply caught between this support level and this resistance level. Now, when you can identify these conditions in the market, once you've identified your support and resistance levels and you can see price moving between them, the most basic way and the most common approach that many traders will use is what's called a mean reversion strategy, or simply fading the range. And this is where traders look to capitalize on the typical reaction that we see at these levels by selling into resistance and buying into support. Okay, so for here, for example, once we've identified our support level and price is traded up here to this resistance, when price trades back down and comes back down to this support level, we can look at what's happened previously. We know there's likely to be some good demand at that level, and we can place a position expecting that price is going to reverse higher. Similarly, when price trades all the way up to that resistance level, we can anticipate that what we're going to see is another instance of sellers kicking in, supply overwhelming demand and pushing price lower. And so all we really need to do is look to capitalize on this dynamic by buying each time price hits support and selling each time price hits resistance. So it's a very simple method that many traders use in these sort of directionless markets once price starts to settle into a range. Now, the important point is about how you actually go ahead and execute your trade, because while many new traders and many aggressive traders will take an approach of simply trading the levels blindly, e.g. simply buying as price hits the level, or selling as price hits the level, what is a far more conservative, far more strategic, and altogether more effective approach is to actually wait for price action confirmation. And for those of you who have been in my sessions before, you'll know this is something I talk about a lot, and this is simply where we look to wait for the presence of reversal candlesticks to give us the go-ahead to place our trade. So looking at this example here, then you can see once again that we have another fantastic range situation. So we've identified two big support touches here. So each time prices hit this band, we've seen really severe moves to the top side. And then again at the top side, we've got this really clear resistance level where each time price has made it up to this zone, sellers have stepped in and driven price lower. So once price is selling off from this resistance level, we've got our support level marked out. All we're looking to do is monitor price as it tests the support level, and we're looking to identify the presence of a reversal candlestick. And so if you look at the level that I've highlighted here, what you can actually see is price trades down into that support level. You can see this first bearish candle stalls on the level. So we get a good early indication that the level is going to hold because price hasn't simply just blown through it. But really, it's this second candle that we're more interested in, because look what happens at this second candle. So we trade down and we touch the level, but then with this second candle, we get this big bullish engulfing candle. So this is a very classic, very well-known bullish reversal signal. For any of you who are familiar with candlestick reading, or even in the candlestick session that we did, you'll know this is a classic reversal candle that is a really strong indication of a likely reversal. And so if you think about what we've actually identified at this level is confluence between two key technical elements suggesting a reversal higher in price. So we've highlighted a support level in the market where we've had two prior bullish reversals, strong bullish reversals. We anticipate that as price trades back down into that level, we're going to see yet a further reversal higher. And then once price has traded into that level, we've identified a bullish engulfing candle. And so it's on the close of that candle that we can actually go ahead and enter our trade. And so what we're doing here is simply waiting. We're waiting for some extra clarity in our trade, for some extra confirmation, but we're protecting our risk and we're managing ourselves, because we're not simply trading blindly at the level. We're waiting for the market to give us a sign that it's going to respect that level. Now, looking for confluence is really at the heart of all of my technical trading, and it's something I talk about a lot in all of these sessions. And confluence can be found between all technical elements, and some of the best confluence you can look for that can really help you improve your trading will be when you can add in technical indicators. So typically where we see these range bound scenarios setting up, what traders will look to do is use momentum indicators to highlight overextended momentum in the market, find confluence between overextended momentum and these support and resistance levels, and then look to use that to strengthen their bias for taking a trade. So one really great indicator for this type of trading is the relative strength index indicator, which again is used to identify overbought and oversold momentum in the market. So if we look at this exact same example again, this time with the RSI indicator turned on. And so here you can see then that the indicator is in the bottom panel, and essentially really all you do is follow this blue line. So you don't even need to know a lot about the RSI indicator, except that there's an upper threshold which signals overbought. So each time the blue line hits the overbought threshold, this signals that the market is vulnerable to a reversal lower. And there is a lower threshold, so each time the blue line hits the lower threshold, this signals that the market is vulnerable to a reversal higher. And so what we're looking to do is monitor the indicator and just see what it's saying about price action as we test that support level. And as you can see, what it's actually suggesting to us is that price is very overextended to the downside. So momentum is oversold in the market. Okay, so price has traded all the way down into this support level, which we've identified by linking up these two prior lows in the market. We've identified our bullish engulfing candle, which we know is a strong reversal candlestick, a strong bullish reversal candlestick. And then finally, we've identified confluence with the RSI indicator, which says that bearish momentum is overstretched and a reversal higher is likely. So what I'm really trying to hammer home here is to get you to think about how you can improve your reasons for taking a trade. So at the first instance, you use your basic support and resistance analysis to highlight these areas, excuse me, which can be potential entry points. And then as price trades into these areas, you're looking to wait for reversal candlesticks, but you can also add in other elements such as referring to momentum indicators, which will tell you whether or not momentum is overstretched and vulnerable to a reversal. So this is a really fantastic way of using support and resistance in conjunction with other technical elements to help you identify these types of setups. Okay, so we talked then about how we can trade support and resistance at its most basic level in terms of operating a mean reversion strategy within a range-bound market. So again, in a range-bound market like this, where buyers are entrenched along the support level and sellers are entrenched along the resistance level, we can simply look to capitalize on that dynamic as it plays out by buying into support and selling into resistance. Okay, so this will play out a great deal in ranges. You'll very often find ranges, and the great thing is they happen on all time frames. Now obviously if you're on the lower time frames, if you're looking at the 5 and 15-minute charts, you might be looking at ranges that play out for an hour or a few hours. But if you're looking at charts such as the daily or weekly, then you could be talking about days, weeks or months. So you need to bear in mind your time frame for the type of trades you're taking, which will obviously impact your risk positioning, and sort of your targets and your stop losses. But the great thing is they do work on all time frames. So regardless of whether you like to take swing trades, set and forget trades, or you put a position on in the evening, check it each evening and hold it for a number of days, or whether you're a more active trader who likes to scalp on the short-term charts, using support and resistance can be equally as effective. Now, the key thing, as I said earlier, to understand is that support and resistance are not static levels. So once you've identified support in the market, it does not mean that this level is always going to be support. And once you've identified resistance in the market, it does not mean that this level is always going to be resistance. These levels do change. However, the great thing is, as we discussed earlier, where I introduced you to the changing nature of these levels, is that you can use this shifting order flow dynamic to your advantage. And one of the best ways I find with trading support and resistance is using the retest of broken support and resistance levels to enter trading positions. Okay, so we know that once support is broken, it can become resistance, and we know that once resistance is broken, it can become support. And this is a dynamic which we can exploit to our advantage, and it's particularly useful in trending markets. So let's take a look at an example. Okay, so in this example then you can see that once again we have a really well-defined support level. Okay, so we've got these two massive touches here. Each time price is traded down into this level, you can see that price has reversed strongly to the upside. We've had these large upside runs. So once we've identified these two levels, we then simply continue to monitor price as it tests the level. And you can see that over here we get a third test of that support level. But this time, look what we see. The buyers that step in at that level are at a far reduced size at this point. So if you look at those prior reactions that we've seen, prices exploded higher from that level. Whereas at this point here, really what we've seen is a very weak and shallow reversal higher. And then at this point, we've actually seen price roll over and break down through that support level. So again, thinking about the underlying order flow dynamic that creates these levels, what are we actually seeing once this level is broken? Well, we know now that demand at this level is weaker than supply. So previously, demand had been stronger. Every time price traded down, buyers stepped in and drove price higher. But now, once price has broken that level, we know that there is more supply in the market. So the sellers are stronger in the market at that level than buyers are. And once price is below that level, once we traded down to this point, what we can then do is monitor price, waiting for it to trade back up and retest that broken support level, anticipating that it's now going to act as resistance, and we can use that as an area to sell. Okay, so if we see what happens, price simply trades back up, retests that broken support level, and again, you can see why I say it's so important to think of support and resistance as areas instead of precise levels, because although price does hold and reverse, we actually pierce up into the middle of that area. Okay, so again, highlighting the importance of thinking of support and resistance as zones or areas instead of specific levels. But once again, what this example should really highlight to you is the efficacy of using support and resistance in this type of setup. So once support is broken, we can look for price to trade up into it and act as resistance, and vice versa. And now the reason why I say that these setups can be particularly useful in trending markets is because if you think of the sort of way that price moves in a trend where we get that zigzagging fashion. So for a bearish trend, we see price making lows, breaking them, retesting them, breaking them, retesting them, vice versa. In a bullish trend, we see price making highs, breaking them, retesting them, new highs, breaking them, retesting them. Once the market starts trending, it very often will retest these value areas because this is where all of the key order flow is happening. So once the market breaks through the low of a bearish trend, it will very often retest it before continuing to make new lows. And again, this offers us a fantastic opportunity to go ahead and place trades. Now, once again, as we discussed when we're operating a range fading situation, a range fading strategy rather, when we're trading in this manner, when we're trading the retest of these broken support and resistance levels, we have the option of either being aggressive and simply entering a trade at the test of the level, or we can be a bit more strategic and wait for price action confirmation. So if we look ahead at this example then, and you can see here that we have a perfect situation where price is moving higher, we've got these large expansive moves to the upside, but we've got clear resistance in the market, okay? So at this point here, we know that although price is trying to break higher, there is strong supply in the market that's pushing price down. So the supply that's creating this resistance is holding price up at this level and pushing price lower. However, we then break out above this resistance level, and so we know that there's more demand in the market than there is supply at this point. Price trades all the way up at this point, and then look what happens. You can see the price starts to reverse and trade lower. So we know we've got a bullish trend. We know we've got this broken resistance that's likely to act as support. However, we don't simply want to enter a trade as price tests the level, because as we discussed before, this is too aggressive and isn't the best way to operate. And so what we actually want to do is go ahead and wait for price action confirmation. Okay, so when we're trading like this, we're simply waiting for the presence of reversal candles that suggest a reversal is likely. And so you can see in the highlighted area then, let's walk through what happens. So we get this really large bearish candle that's most likely in reaction to a news release, trades all the way down and actually pierces the support level. So if you had just been trading the level blindly, just putting in an order at the levels once you'd highlighted them, you most likely would have been stopped out unless you were using quite a wide stop. So we wouldn't have entered on that first candle. We wouldn't have entered on this second candle, this small bullish candle, but what this does do is give us an indication that there's been a lack of momentum and some indecision in the market. Really, it's this third candle that we're interested in, because what you can see there is that once again we get another bullish engulfing candle. So we get a strong bullish reversal candle which actually closes back above that support level, and that signals to us that there is a shift in order flow in the market, and that buyers are stepping in strongly at that level, and that gives us the go ahead to enter our trade. Okay, so we're not just buying support as price tests it, we're waiting for price action to give us a signal. We want confluence between the candlesticks themselves and the support or resistance levels. And once again, another fantastic way of using technical confluence is to use indicators. So if we put the RSI indicator on once again, you can see that we actually identify added confluence. So excuse me. So this is our resistance level that we'd highlighted. Price had broken out. We're monitoring price once it's above the resistance level because we know we're in a bullish trend and we're looking for an entry point. So we're waiting for price to trade back down and retest that support, which it does at this point here. However, we're not just going to buy the level, we're waiting for confluence between those candlesticks, reversal candles. We've identified our reversal candle at this point, and then we look finally to the RSI indicator to tell us what the momentum picture is in the market. And you can see once again that we get fantastic confluence because the RSI indicator has moved below its lower threshold, signaling that bearish momentum is overextended, it's oversold, and we're likely to get a reversal higher. Okay, so we've got brilliant confluence there once again. So just as we saw when we're trading the range fading scenario, where we identify price moving into support and resistance, wait for a reversal candle, and then look to see what the momentum indicators are saying, we're doing exactly the same thing here. We've identified our support level, we've identified our price action reversal signal, the bullish engulfing candle, and then finally we've measured, we've referenced the RSI indicator, which tells us that bearish momentum is overstretched and we're due a reversal higher. So this is a fantastic example of the sort of confluence that we're looking for. And again, it's a very simple, very methodical process which you can follow, which will help you identify fantastic trading entries. Okay, everyone, that's been a fantastic session. I really enjoyed going through support and resistance with you. It's one of the first sort of technical, one of the first aspects of technical analysis, rather, that made a change in my own trading. And so it's always really great to go back over these setups and talk through them. And we've looked really at two scenarios here. We've looked at trading a range fading scenario and using retests of broken support and resistance. And we've looked at how you can use confluence between different technical elements to improve your chances of capturing a reversal. And if you really practice just these two setups in the market and develop good trade management and always use favorable risk reward, then just these two scenarios alone can help you to really advance your trading and start hitting some good profitable trades. So I hope you've enjoyed this session and you're looking forward to getting to the charts and practicing identifying these levels and taking some trades yourselves. And I look forward to catching up with you all next time. Okay, thanks a lot, everyone. Take care. Goodbye.